imagine for a moment having, well, real-time insights and these hyper-accurate forecasts. The kind that, used to be just for the biggest financial institutions.
Right.
Now, imagine that's actually at your fingertips. Picture a sort of data-driven crystal ball for your investments, something that, honestly, just a few years back felt like pure science fiction.
Exactly.
Well, welcome to the rapidly evolving world of artificial intelligence in investment management. This isn't just another tech buzzword, is it? It feels like a profound, really transformative force reshaping finance.
It absolutely is. And investors, modern investors, now have access to incredibly sophisticated AI tools, tools that can analyze just vast amounts of financial data and even, highly unconventional alternative data.
That's the fascinating part.
And what's really compelling, I think, is the sheer speed of this adoption. It's not just a trend, it's becoming a financial imperative, really.
You see the numbers everywhere.
Yeah, industry surveys are showing upwards of 90% of investment managers are either already using AI or planning to. And more than half, a full 54%, have already integrated it into their core strategy.
It's huge. Over half already.
And the real insight there is how quickly the industry's moved from, let's say, experimentation to actually showing demonstrable ROI. An astonishing 92% of companies, they're reporting tangible benefits from AI integration.
Wow, 92%.
And the global AI and finance market, it's projected to hit something like $17 billion by just next year, 2025. It's growing at an unprecedented pace.
That's undeniable then. So our mission today is to really deep dive into what AI in investing actually means, beyond the headlines.
Right.
We'll unpack how it processes information, uncover some of the most maybe surprising and unexpected ways it's transforming investment strategies, and crucially, dissect its significant limitations and challenges too.
Which are definitely there.
And ultimately, we want to explore what this sort of seismic shift means for you, the individual investor, as you navigate this, well, brave new financial landscape. Okay.
All right, so to really pull back the curtain on this, we need to strip away the buzzwords. When we say AI in investing, what are we truly talking about? And maybe more importantly, how does this sophisticated engine actually, churn through information? Is it just a souped-up algorithmic trading system? Faster, but the same idea.
Yeah, that's a common misconception, and it's important to clarify. While speed is certainly a factor, AI in investing goes far beyond traditional algorithmic trading.
Yeah.
That usually relies on pre-programmed rules, right?
Okay.
At its core, AI here is the powerful convergence of machine learning, data science, and deep financial analysis. Think of it less like a calculator following instructions and more like a colossal, intelligent data engine that actually learns and adapts.
So how does that learning part work then? What kind of data is this engine actually consuming?
It's voracious. I mean, these AI systems process both structured data, that's your, neatly organized numbers like price movements, trading volumes, financial statements.
Suspect.
But
Exactly. But also a massive amount of unstructured data. And this is where it gets really interesting.
Okay.
We're talking about sifting through news articles, gauging social media sentiment, analyzing satellite imagery, maybe tracking parking lot occupancy at retail chains, things like that.
Wow, satellite imagery.
Oh, yeah. Or even monitoring IoT Internet of Things sensor data from municipalities, manufacturing facilities. It could be subtle language patterns in patent applications, or even real-time GPS data from cargo ships to assess global supply chains.
It's incredible scale.
It really is. Systems like IBM Watson's financial applications, they can analyze thousands of listed companies in real time, processing over 1 million unique data points daily.
1 million points daily. That's just hard to grasp. But how does it turn all that raw, often kind of chaotic data into something genuinely insightful for an investment decision?
Right. That's where the pattern recognition layer comes in. And this is where AI truly differentiates itself. It uses advanced techniques like quantum machine learning, QML,
QML.
which, simply put, uses principles of quantum mechanics for, well, exponentially faster and more powerful calculations on complex probabilities. It also uses computer vision for analyzing visual data like those satellite images.
Got it.
This lets AI systems identify really subtle correlations and weak signals that traditional methods or even the sharpest human analyst might completely miss.
Like what kind of signals?
Well, for instance, some systems now track the emotional content of earnings call transcripts in real time, using natural language processing, NLP.
So not just the words, but the feeling behind them.
Exactly. Going beyond keywords to understand tone. Others use large language models, LLMs, to scan and analyze just vast amounts of social media posts, extracting nuanced sentiment that's far beyond simple positive or negative.
Can you give us a kind of real world, maybe hypothetical example how these different signals might come together?
Sure, certainly. Let's think about analyzing the semiconductor industry. A traditional analyst might pore over financial statements, look at reported inventory, gross margins.
Center stuff.
Right. A high-frequency trading algorithm would track real-time price momentum, order flow. But an AI system, it takes a much more nuanced approach.
How so?
It might notice, for example, that a key manufacturer's power consumption has significantly increased, way above seasonal norms. It could pull that data from utility companies.
Okay.
Simultaneously, it might detect a noticeable rise in their suppliers' job postings for, say, quality control positions on online job boards,
Uh-huh.
and maybe a sudden surge in academic papers citing their proprietary technology found in scientific databases.
So none of these are slam dunks on their own.
Exactly. Individually, none are definitive investment signals. But when synthesized by the AI, these weak signals might collectively indicate, perhaps, an imminent production breakthrough that gives you truly meaningful, actionable foresight.
That semiconductor example really paints a vivid picture. It's almost like having a financial markets detective. So once AI pieces together these often hidden signals, how does it move from, recognition to actual action?
That's the adaptive decision-making layer. The AI doesn't just identify patterns, it contextualizes these insights against broader, real-time market conditions.
Context is key.
Absolutely. It adjusts position sizes, timing, based on factors like liquidity, how correlated the asset is with others, wider macroeconomic indicators. This creates a dynamic, evolving investment approach that can constantly adapt. That's something neither traditional human analysis nor fixed rule-based algorithms can fully replicate.
Okay, now for the really game-changing applications. Let's dive into some of the, surprising and powerful ways AI is being applied right now, starting with, arguably, the holy grail, analyzing and picking stocks.
Absolutely. AI systems excel at this because they can simultaneously evaluate fundamentals, technical indicators, new sentiment, market trends, all at a scale and speed impossible for humans.
And they can adjust focus.
Exactly. What's more, they can dynamically adjust the weight given to different factors based on prevailing market conditions. So, for example, during market stress, an AI might automatically give more weight to technicals and sentiment, shifting focus from maybe longer-term fundamentals.
And there was that fascinating Stanford study on this, wasn't there? The numbers were quite eye-opening.
They were, as the researchers themselves put it, stunning. Yeah. A Stanford study found that an AI analyst, using only publicly available information, outperformed 93% of mutual fund managers
93%.
by an average of 600% over a 30-year period, from 1990 to 2020.
600%.
Yeah. This AI generated an additional $17.1 million of benchmark-adjusted returns per quarter, on top of what the human managers achieved.
That figure is just staggering. 600%. But, for the skeptics, what were the key factors in that study? What allowed for such a monumental outperformance? And are there any, maybe, limitations critics might point to?
Well, the primary factor was the AI's ability to process and identify these subtle, non-obvious patterns in vast datasets that, humans simply can't keep up with, spotting very weak signals that, when combined, became powerful predictors.
Right.
However, it's crucial to understand the caveat the researchers themselves mentioned. If every single investor were using this exact AI tool,
The edge disappears.
exactly, much of its statistical advantage would likely diminish because the market would adapt to its signals. It really highlights that the edge comes from unseen insights, not universally known ones.
That's a really vital piece of context.
Yeah.
So, okay, beyond just picking stocks, how else is AI helping us get a much deeper read on the market sentiment?
It's revolutionizing how we summarize investor sentiment. We're moving far beyond simple positive-negative classification. Modern AI uses contextual sentiment analysis through NLP.
Natural language processing again.
Right, which can understand nuance, sarcasm, implicit meaning in text communications. For example, an AI could evaluate a CDO's earnings call. It wouldn't just look at the literal words spoken, but analyze their tone, speaking patterns, subtle signs of uncertainty in their answers, even if the prepared remarks were outwardly positive.
Giving you early warning signals.
Potentially, yes. Signals that might otherwise be missed by traditional analysis.
That's a huge step up from just keyword spotting.
Yeah.
What about managing an entire portfolio? Can AI truly optimize asset allocation?
Absolutely. AI tools are fantastic for portfolio management and asset allocation. They optimize based on your specific goals, your risk tolerance, and real-time market conditions. continuously monitoring and rebalancing.
Any examples?
Sure. BlackRock's Aladdin platform, for instance, uses predictive analytics for real-time risk assessment across massive portfolios. It's helped firms see up to 20% increases in returns by continuously analyzing markets and rebalancing.
20% increase is significant. So with all that capability, are AI-powered ETFs like, say, the Amplify AI-powered equity ETF, AIEQ, are those the new benchmark for individual investors?
Well, AI-powered ETFs like AIEQ do use sophisticated AI, including IBM Watson, to select stocks. However, it's really crucial to understand that AI is a powerful tool, but it's not, a guaranteed path to superior performance.
Right, no guarantees.
For instance, by January 2025, AIEQ actually underperformed the benchmark S&P 500 ETF. So this illustrates that while the tech is incredibly advanced, it's still subject to market realities. It doesn't inherently guarantee outperformance over broad market indices.
That's a very important distinction. How about personalized advice? Can AI actually replace a human financial advisor for individual investors?
It's moving beyond the traditional risk questionnaires, definitely. AI can paint a much more comprehensive financial picture, analyzing your complete financial situation, including granular spending patterns, career trajectory, geographic location.
Like where you live and work?
Yeah, concentrated industry exposure through your employment, cash flow, even upcoming life events, buying a home, kids' college.
Give me an example.
Okay, for a software engineer in Silicon Valley, an AI might actually recommend lower exposure to tech stocks. Why? Because it recognizes their human capital is already heavily tied to that sector.
That's smart. Recognizing existing risk.
Exactly. And it continuously learns, adapting recommendations based on how you react to market movements, your long-term financial behavior. It tries to keep emotions out of the investment process.
But what about risk itself? That's always the biggest factor, right? Especially in these complex, interconnected markets.
AI significantly enhances how we evaluate predictive models and risk. Now, no system can predict market movements with certainty, let's be clear.
Of course.
But AI helps investors understand probability distributions of various outcomes and adjust strategies accordingly. These systems can dynamically map incredibly complex interconnections of risk.
Like a domino effect.
Sort of. For instance, detecting how commercial real estate stress could cascade through regional banks, then impact small business lending, and ultimately affect consumer spending and retail stocks.
Connecting those dots automatically.
Precisely. JP Morgan Chase, for example, uses an AI framework to significantly enhance its stress testing and scenario analysis, identifying vulnerabilities long before a human team perhaps could.
Beyond just the current market conditions, can AI help us learn from history in a maybe smarter, more relevant way?
Absolutely, through AI-powered backtesting. Unlike conventional backtesting, which often just replays historical scenarios with equal weight,
Right.
AI understands how market conditions and relationships actually evolve over time. It can intelligently weight historical periods by their relevance to current conditions.
So it knows what history matters now.
Exactly. So when backtesting a strategy for, say, electric vehicle stocks, an AI would recognize that data from the 1990s automotive industry is far less relevant. The business models, market dynamics are fundamentally different today.
Makes sense.
It can also identify regime changes, even simulate hypothetical scenarios that haven't actually occurred historically, filling in gaps in our real-world experience.
That sounds like it could really fill in a lot of data gaps, especially for rare market events. Speaking of gaps, what exactly is synthetic data in this context? I've heard that term.
Yeah, synthetic data is a really innovative development. It's where artificially generated data sets mirror the statistical properties and relationships found in real financial markets.
Why is that useful?
It's incredibly valuable because historical data for rare, significant market events like the 2008 crisis or the 2020 pandemic sell-off are inherently limited. You only have a few examples.
Right, thankfully.
AI can generate thousands of synthetic crisis scenarios, preserving key characteristics but introducing variations to build more robust models. It's also super useful for new financial instruments like cryptocurrencies, where historical data is relatively short.
How does that work?
It combines known characteristics of crypto with patterns learned from established markets to generate plausible historical data.
But I'm guessing there's an important caveat with synthetic data. It can't be a complete replacement for real-world info, can it?
You're absolutely right. That's the critical caveat. Synthetic data must always be used alongside real market data and traditional analysis. The best systems use a hybrid approach.
Hybrid.
Yeah, where synthetic data augments rather than replaces historical data. It helps fill informational gaps, train models on extreme scenarios, but keeps things firmly grounded in actual market behavior.
Okay, that makes sense. And finally, let's touch on real estate. It's an industry traditionally so reliant on local expertise, human judgment. How is AI transforming that space?
AI is having a profound impact there, too. Projects like Foresight Realty demonstrate AI's ability to analyze just massive amounts of disparate real estate data. Historical prices, consumer behavior, economic indicators, local zoning laws, even social media trends.
All of it.
All of it. This allows it to forecast market trends and property value changes with, frankly, unprecedented accuracy, like the likely impact of a new highway or a major corporate relocation on surrounding properties.
And it automates the tedious stuff, too.
Oh, yeah. Automates tasks like property valuation using automated valuation models, AVMs, lease management, comprehensive tenant tracking, a lot of the administrative burden.
So it handles a lot of the grunt work. What about getting a pulse on market sentiment for real estate?
No.
That seems very localized and, well, human.
Yes. Sentiment analysis in real estate is a key application. AI tracks social media, news, forums to gauge public sentiment about specific properties or areas, providing early indicators of demand shifts.
Right.
Like a sudden increase in positive online conversations about a neighborhood because of a new mall or a great school. AI can spot that early.
Interesting.
And beyond that, AI enables predictive maintenance, analyzing building infrastructure data from smart sensors to predict when components like HVAC systems might fail, allowing proactive maintenance, significant cost savings.
And results are good.
The results are impressive. AI price prediction models in populated areas can surpass 90% accuracy. And sentiment analysis really reveals nuanced insights that human analysts might just miss. Now, while the capabilities we've discussed sound, well, immense, it's crucial we ground ourselves in reality here.
Right.
Every powerful tool has its limitations, and AI in investing is definitely no exception. What are some of the biggest hurdles we need to be aware of before we, get carried away?
Definitely. It's not a magic bullet, as we saw with that AI-powered ETF example.
Mm-hmm.
What are some of the biggest inherent challenges then?
First and foremost, I'd say AI's heavy reliance on data quality and availability. That's a major limitation.
Garbage in, garbage out.
Precisely. AI models need vast amounts of accurate, complete, reliable data to make sound predictions. But financial market data can often be noisy, incomplete, or contain inherent biases.
Leading to bad predictions.
Exactly. Inaccurate predictions or suboptimal investment decisions. Furthermore, unpredictable events, geopolitical tensions, natural disasters, sudden regulatory changes, they might not be fully captured by historical data. Makes it hard for AI models to account for them.
That makes perfect sense. Input flaws mean output flaws. And what about understanding how the AI actually arrives at its decisions? That's been a big talking point with AI generally, hasn't it?
It has. That brings us to the black box problem, the lack of transparency and interpretability in complex AI models, especially deep learning algorithms.
You can't see inside.
Often, yeah. It's difficult for investors, even regulators, to understand precisely how these models arrive at their decisions. This opacity creates challenges for investor trust, regulatory compliance, ethical oversight.
So how are people tackling that?
Well, there are active efforts in explainable AI, XAI, trying to make models more transparent, but it's an ongoing challenge, balancing true interpretability with maintaining high predictive accuracy. It's a trade-off, often.
So we can't always see the why behind the AI's what. What about the risk of the AI getting, too good at seeing patterns in past data, maybe leading it astray in the future?
That's called overfitting. Yeah, it happens when an AI model becomes too closely tailored to historical data. It learns the noise along with the signal.
So it performs badly in the real world.
Exactly. Poor performance in real-world scenarios. And there's also the critical issue of market adaptation. As more firms adopt similar AI strategies, the competitive advantage can diminish because the market itself learns and adjusts.
Like we talked about with the Stanford study.
Exactly. We touched on this with their caveat. If everyone were using that exact AI tool, much of its statistical edge would inevitably go away. The market is a dynamic entity. It reacts.
Beyond the technical challenges, are there broader implications, maybe around who benefits from this tech or how it interacts with existing market structures?
Yes, definitely some significant ethical and regulatory considerations. There's a concern about access disparity, meaning that highly sophisticated AI tools might remain primarily accessible to large institutions. potentially creating a significant tech gap and market advantage over smaller players or individual investors.
Widening the gap.
Potentially, yes. Additionally, if AI models are trained on historical data that contains inherent biases or reflects past market anomalies,
They learn the lies.
it could inadvertently perpetuate these patterns, leading to suboptimal or unintended investment outcomes. It's not the AI being biased itself, but the data it learns from, reflecting historical human actions and biases.
And the regulators. Are they keeping up?
Well, that's another challenge. Regulatory bodies are still grappling with how to effectively monitor and regulate AI in finance, particularly concerning potential market manipulation or the consequences of these data-driven inaccuracies or biases. There's a very real regulatory lag.
And all this power needs powerful infrastructure, right?
Yeah,
What are the practical risks involved there?
exactly. There's a heavy dependence on robust tech infrastructure, high-speed data processing, extensive cloud computing, secure data storage.
Which means vulnerabilities.
It introduces inherent risks, yes. Vulnerability to cyber attacks, technical failures, data breaches. Any disruption could lead to significant financial losses or even market instability.
That infrastructure and the AI itself sounds prohibitively expensive for many.
It is. The high initial costs of creating, implementing, and maintaining sophisticated AI models are a major barrier. It requires significant investment in cutting-edge tech, specialized software, and critically highly skilled personnel, data scientists, engineers.
So smaller firms or individuals are locked out.
It can be prohibitive, yes, which further contributes to that access gap we mentioned earlier.
And is there a human cost to all this automation in terms of jobs?
Potentially, yes. Widespread AI adoption may lead to shifts in the workforce. As tasks like routine property valuation, basic data analysis, many administrative functions become automated.
Jobs could disappear.
Well, roles will certainly change. While new roles in AI development, oversight, specialized analysis will emerge, it's unlikely to be a one-to-one replacement for those displaced from more routine roles. It could lead to a restructuring of the financial labor market.
So considering all these significant hurdles, the data issues, the black box, overfitting costs, potential job shifts, what does all this mean for you, the individual investor? The person who likely isn't running a hedge fund with a dedicated team of data scientists.
That's the crucial question, isn't it? And while the most sophisticated AI capabilities, let's be honest, remain largely confined to institutional investors right now.
Tools are becoming available.
Yes, tools are increasingly becoming available to individual investors, though often with some inherent constraints or limitations compared to the institutional versions. It's best to view them as powerful decision support systems.
Port systems, not replacement.
Exactly, not complete solutions that take over your entire investment process.
So what are some of these more accessible AI tools we should be aware of? Perhaps for someone wanting to, dip their toes in.
Well, the most accessible entry point for many are probably the AI-powered robo-advisors.
Yeah.
These have evolved beyond simple rule-based systems.
So.
They now incorporate machine learning for things like optimizing tax loss harvesting, intelligent rebalancing, more dynamic risk management based on market conditions.
And they're affordable.
Typically, yes. Much lower annual fees compared to human advisors, usually ranging from maybe 0.25% to 0.75%, and very low minimum investment requirements, often $100 or even less.
So given their automation and lower cost, are robo-advisors always a superior choice compared to a traditional human advisor?
Not necessarily, no. Robo-advisors offer clear advantages in cost efficiency and automated precision, especially for straightforward investment goals.
What?
But human advisors provide that deeper, personalized understanding for complex scenarios, navigating nuanced family situations, providing behavioral coaching during volatile markets that human touch.
Some of you mix.
What's increasingly common are hybrid approaches, combining the best of both worlds. And it's important to remember, AI doesn't inherently make robo-advisors outperform human advisors in terms of raw returns. Higher human advisor fees can lead to lower net returns, but the value often lies in that human element for complex planning or emotional guidance.
Okay. Are there other direct AI investment options for individuals beyond robo-advisors?
Yes, there are those AI-managed ETFs, like the AI EQ we mentioned earlier. They offer exposure to AI-driven stock selection strategies in a fund format.
Right.
Additionally, many retail brokerages are now incorporating AI-enhanced features into their platforms. More advanced stock screeners, maybe sentiment analysis tools, though these often rely on more traditional data than the big institutions access.
What about the large language models everyone's talking about, ChatGPT, Gemini, those sorts of things? Can I use those for investing? Maybe get a quick stock tip.
Ah, yes, you absolutely can use them, but with significant caution and a very clear understanding of their purpose.
Okay, caution needed.
Widely available LLMs like ChatGPT, Gemini, Grok, Claude Sun, they can be incredibly powerful research assistants.
Oh.
You can prompt them to summarize complex financial statements, synthesize key insights from multiple research reports, even deepen your financial education by explaining complex concepts in accessible terms. Think of them as super fast, knowledgeable librarians.
But not as advisors.
Definitely not. They should never, ever be used as primary decision makers for your investments. They can hallucinate, provide incorrect or outdated information. They lack the real-time, nuanced market understanding needed for trading.
So use them to learn, not to trade.
Exactly. Use them to enhance your understanding, not to make direct trades based on their output.
So for someone wanting to maybe cautiously explore AI-enhanced investing, what are your quick, actionable tips for optimizing their strategy safely?
Okay, quick tips. First, clearly define your investment goals and risk tolerance. AI is a tool to serve your objectives, not the other way around.
Got it. Number one, know yourself.
Right. Second, research and carefully compare different AI-powered platforms. Find one that aligns with those objectives and your comfort level.
Do your homework on the tools.
Third, start small, maybe with just a portion of your portfolio while you learn the ropes and observe its performance. Don't jump in head first.
Makes sense. Test the waters.
Fourth, consider combining multiple AI tools to get different angles. Maybe pair an AI-driven stock screener with sentiment analysis from an LLM for research.
Get a fuller picture.
Fifth, regularly monitor and evaluate the AI system's recommendations and its real-world performance. Don't just set it and forget it.
Stay engaged.
And finally, and this is probably the most important, maintain a balanced approach. Combine AI insights with your own human judgment and those time-tested traditional investment principles like diversification and long-term planning.
Don't throw out the fundamentals.
Never.
That's a solid framework. But with any new technology, especially one as complex and maybe hyped as AI, there's always the risk of fraud, right?
Yeah.
How can listeners protect themselves from AI-related investment scams?
This is absolutely critical. Fraudsters are very adept at exploiting complexity and the perceived, magic of AI with unrealistic claims.
What kind of claims?
Be extremely wary of anyone promising a revolutionary AI algorithm that can't lose, or guaranteed stock picks using advanced artificial intelligence, or any kind of risk-free system. Those are huge red flags.
If it sounds too good to be true.
It probably is. Always, always verify the registration status of any investment platform or professional. Use recognized regulatory authorities like the SEC or FINRA's Broker Check. A legitimate platform will be transparent and properly registered.
And what about these AI-generated fakes we're hearing more about, like deep fakes? Can those be used in scams?
Yes, absolutely. Be particularly alert to AI-enabled technology scams using deepfake videos, AI-generated audio, fake websites, or sophisticated chatbots designed to impersonate legitimate professionals or executives.
So verify identities carefully.
Independently verify identities, especially for online communications or any unsolicited outreach. The key warning remains: be incredibly skeptical of any promises of guaranteed or outsized returns or these risk-free systems.
Because real AI doesn't promise that.
Exactly. Legitimate AI tools are powerful enhancements for analysis, but they cannot guarantee profits. Risk is inherent in investing.
Okay, looking beyond today then, what does this whole trajectory imply for the future of finance? What exciting developments are maybe on the horizon for AI in investing?
The trajectory is incredibly promising, I think, with several potentially groundbreaking developments on the horizon. On the pure tech front, we're looking at quantum computing.
Quantum, okay.
It has the potential to revolutionize financial modeling, solving incredibly complex optimization problems exponentially faster than even current supercomputers. Could significantly enhance everything from portfolio optimization to risk assessment, algorithmic trading.
A quantum leap, potentially.
Literally, perhaps. Then there's reinforcement learning, RL. It's a fascinating subset of machine learning.
How does RL work?
It learns optimal strategies through trial and error in dynamic environments. It learns from its own mistakes and successes in real time. This makes it particularly well suited for these ever-evolving, uncertain market conditions.
Learning on the fly.
Exactly. And finally, the continued crucial development of explainable AI, XAI. That will be vital for building trust and facilitating regulatory oversight, making these complex models more interpretable, more transparent, letting us understand why a decision was made.
Getting inside that black box.
Hopefully, yes.
Beyond the core AI tech itself, what other broader trends should we be watching? Things AI will integrate with.
We'll definitely see much deeper integration with the Internet of Things, IoT, and smart buildings. Smart buildings, for example, can provide real-time data directly to AI models.
For what purpose?
For granular property status tracking, identifying problems like HVAC failures before they happen, enabling truly predictive maintenance.
Saving money and hassle.
Right. Another exciting trend is the integration of blockchain with AI.
Blockchain and AI together.
Yeah. Blockchain's decentralized nature can enhance transparency, security, trust in real estate and other financial transactions, unalterable property records, for instance, while AI monitors for ownership shifts or suspicious transactions on that chain.
Interesting synergy.
And finally, AI systems are becoming far more sophisticated at leveraging ESG, environmental, social, and governance and sustainable investment analytics.
Going beyond just ticking boxes.
Exactly. Going beyond simple data points to evaluate companies' true ESG performance to predict future outcomes. Especially important given that ESG assets are projected to reach, $53 trillion globally. AI will be key to analyzing that effectively.
So to kind of wrap this up, AI is undeniably a powerful, rapidly evolving tool in modern investing. No question about that.
Absolutely.
It offers capabilities that significantly enhance decision-making, efficiency, personalization, capabilities that were, frankly, unimaginable just a decade ago.
True.
However, and this seems crucial, it's vital to remember that AI is not infallible. It truly complements rather than replaces human judgment and critical thinking.
Precisely. That's the key takeaway. For you, the learner, AI should be viewed as a tool that can dramatically enhance your understanding and your investment process.
An enhancer, not a replacement.
Exactly. Not a substitute for fundamental financial literacy or your own due diligence. It's really about intelligently combining these powerful tools with your own informed decisions and solid risk management principles.
Okay, so as AI continues to embed itself deeper and deeper into our financial lives, transforming everything from how we pick stocks to how we analyze real estate, what ongoing responsibility do you have? Not just in adopting these tools, but in truly understanding their inner workings, their immense strengths, and yes, their surprising limitations. How do you ensure you stay well-informed and make the absolute best decisions for your financial future in this new era?